Assuming so, if you wouldn't mind. Just letting me know all that is working and everything is okay. And don't be shy. Pretty casual, pretty relaxed here, at least as far as I'm concerned. But all right, excellent. That's good. And we'll give everybody a moment or two here to get on board. Hey, Ray. Hey, everybody. Pretty fun little day here for me. This is I joined T3 just a little over a year ago, and prior to that, the service that we'll touch on a little bit today, Options Gambit, that was referred to as the profit machine. But we used to open registrations, once a month or so. And then we came to T3, there was a lot of reorg that needed to be done and changes. For example, the name. little, little stricter over here, I don't want something called the profit machine, implying that we have a machine that generates profits. So we had to change the name. But anyway, this is the very first Options Gambit webinar we have done. So it's kind of fun. Now, as we wait a few more minutes here, not a huge fan of long, drawn out, canned presentations. So, I have a handful of slides here to keep us organized and moving in the right direction. But um, all in all, I like talking about real stuff. So we'll switch to the trading screen here in the middle. And on one hand, we want to talk about the topic of the webinar here, the year ahead, right? That's a very common question people like me get asked. Like clockwork, at the end of one year and going into the next, what are we thinking? What do you think is going to happen? And this, that, or the other. Um, my perspective is never really one of a fundamental view. I am a. We'll get into it here. For those who don't know who I am, we'll talk about that a little bit more in a second. But it's a CMT, right? A chart guy. Subscribe to the idea that everything that is known by the market, right? So if we want to know what the market's thinking, just look at it, right? Analyze it. Talk is cheap, right? Put our money where our mouth is, right? In other words, anybody can have an opinion on a stock, but where are you putting your money, right? Would you bet on it, so to speak? So I like to talk a little bit about this, that, or the other. So we'll touch on a little bit of both. Hello, Raj, California. How's everything going out that your way? Hopefully safe. Still have a home. Hello from Arkansas. Wow. And yes, we did. We notched it. We'll talk about that today. We just closed a 200% winner today. Speaking of options gambit, while we're here, hey Raj, I'll be in San Diego 2 weeks. I'll be out that way. I'm going to grab a coffee. I'll be in Carlsbad. Is that close to you? Yeah, remind me at the end of the call. You can email me. All right, it's pretty simple. It's just Christian. You see the name up there. Well, I don't know if it shows it on your end, but at the top of the StreamYard platform there, you'll see the name Adam Mesh. Yeah. Um, my email is just Christian at adammesh.com. So, all right, we've given it the standard 5 minutes, so we'll dive on in there. But yeah, we'll talk a little bit about. Ooh, got somebody in San Jose. Delmar Pizza. How close would that be to me, Flipper? I'll be in Carlsbad. Is it an Uber away? Because if so, count me in. Count me in. But okay, as I said, so we'll kind of do a little bit of this, that, or the other. Like I said, I'm not really a big fan of like canned agendas or talking people to death. I like to look at charts, look at stocks, talk about stuff. So yeah, we will. We will look at that trade because it's a two-part topic today. What are we seeing in the year ahead, and then how would we trade it? What are we planning on doing here? Uh, as the title up top says, how to trade big moves with options. That is what we do in Gambit. It's what we do in all the services that I operate with T3. Well, not all, I guess. Smart Trade's a little more conservative for sure, but whether we're talking about Gambit or Prime Time or something of that nature, I'm a huge fan of defense wins championships, but a good offense is fun too, right? So we aim for the bigger gains, and we try to make the you know not trying to hit lottos or anything, just trying to do sound analysis. So we'll talk about that. I was kind of happy because we wait for our trades, we wait for our setups. We can't really control what happens once we're in, right? So knowing that a webinar like this is scheduled a month out, I don't know that we'll be in a trade or not. So it's nice. We closed it out this morning. We'll talk about that. But yeah, let's kind of get into it there. There's that wonderful disclaimer I'm sure we're all used to. So let's browse that over. My guess is if you're here, you already know and probably already experienced that yes, you can lose money in trading. There are no guarantees, yada yada. When we talk about technical analysis, and particular me as a CMT, um, we're not dealing in absolutes or guarantees. Probabilities, implications, scale. At the end of the day, good risk reward, right? Risk a little to make a lot. It solves all your problems, which is always a big lesson I try to teach my students, right? Um, Too often we're bogged down by the latest indicator craze, 5 or 6 indicators, and we're trying to figure out why we're still not making money because indicators and which ones you use aren't really, you know, aren't very important in the grand scheme of things. If you don't believe me, then explain to me how traders were making money before software programs and trading platforms. In other words, it's true, right? You can use whatever indicators you want, whoopity do, right? To each their own in that department. At the end of the day, traders are making money all for the same reason. So I tend to focus more on those reasons, the things that are actually going to make you money, not some cute gimmick or scam on X or something, right? You want to use Bollinger Bands, have at it. You like your VWAP, go get you some. You like 8 21-day moving average, cool. Elliott Wave, not my cup of tea, but go get it. At the end of the day, none of those are making you money. None of those are losing you money, right? Just the tools you use to play in the game, right? Or as I like to say, it's the golf clubs in the bag. You can use whatever clubs you want. At the end of the day, if you don't have the fundamentals down, who cares? If you do have the fundamentals down, then you're winning no matter what, right? Got a good grip, good stance, good backswing, hip rotation, all that fun stuff, and you can connect with the ball, you're probably going to beat me 100 times out of 100. Doesn't matter what clubs I use. So it's the biggest lesson I try to teach everyone because my approach to the markets is very much a keep it simple. Don't try to reinvent the wheel here. As indicators go, last thing I checked, the only one that's paying you is price. So I'm very confused at why most of the traders I work with never look at it. you know, VWAP, Fibonacci. Okay, blah, blah, blah. What about price? Fibonacci never paid me a penny. Price does, though. And when I lose, it certainly isn't because of what Fibonacci retracement I looked at. It's because the price went the opposite direction, right? So those core tenets. Now I had to learn this myself. I've been trading for over a couple of decades. I think it was 2002 or three, right? And I had to learn these lessons myself. Right? I remember I got into markets with an outfit. I don't know if they're still around, but Invest Tools, green arrows, red arrows, right? If I remember correctly, their shtick was 30-day moving average, MACD, stochastics. I think that was it. But my coach had me putting up Bollinger Bands and the 50-day. Um, what else? And RSI. And as you might expect, I just simply lost all my money all the time. So once I figured out, and part of that was becoming a CMT, as you see there at the bottom. Once I figured out that, I don't want to say scam or gimmick, but it is kind of the idea that indicators are going to take me from non-successful to successful. That's kind of a gimmick. I don't know that anybody's intentionally trying to gimmick or scam anybody, but if no one's teaching you position size, risk management, risk reward, discipline, controlling emotion, yeah, you're wasting your time, right? That's kind of what I've learned both in studies and experience and with students over the years. So, uh, stock and options coaching is kind of what I do. Every trade service that I operate, including Gambit, which we're talking about today, comes with some coaching, right? I actually have my own mentoring program there, lifetime trading system. Well, that's all I do is teach everything from A to Z, right? So at the core, I'm probably a coach, right? Um, but yeah, so that's me. Like I said, I'm not a huge fan of big, long, drawn out. If you have any other questions for me, fire away. But I like to spend more time talking about stocks and markets and trading and making money than myself. Um, but yeah, Wealth Pop, division of T3. I think that's what we call it, a division, right? Part of the T3 Live, if I remember correctly. So, all right, good deal. So let's keep it going. All right. So the common question, is a recession looming? So here's the thing. I'm a huge fan of just, again, charts. History. What tends to happen? Okay, knowing that there's no guarantee, right? But I think maybe if I looked at my desktop right now, I probably got 10 different charts that we've covered over the last 30 to 45 days. So I don't want to bore you to death for an hour looking at 10 to 15 charts. So I just simply brought in two where you can kind of make some decisions for yourself. One of which, okay, that I thought was worth a look is the taking the civilian unemployment rate and slapping a 3-year moving average on it, right? So the moving average, the blue line, the unemployment rate, the black. All right. So as you can imagine, not too terribly hard to figure out here. As employment rate spikes, right, black line go up, employment rate come down, black line come down. And then we have the average of it. In the background, you're going to see each of the recessions over the last 70 years in the light gray. The biggest of which during this time frame is that doozy from back in 2000, 7, 8, 9. A little itty bitty guy back there in 2020, right? The COVID induced. Okay. And what we will see here is that every single time the black line is crossed above the blue line, you're going to see a little red circle. And what did we get every single time? As a matter of fact, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Really kind of 10, but 10 and 0, right? For a recession. So, Exhibit A, take that information for what you think it's worth, right? Obviously, you can see the point we're getting at there at the end. We have seen that unemployment rate move above the moving average again. Could we go to 10 and 1? You betcha, right? You bet. But could this also be an exceptionally reliable indicator of what's to come? There's also that, right? So you pan out a little bit, right? And let's say you think, you look at COVID as more of a one-off induced by pandemic, et cetera, et cetera. Well, then that means it's been a nice, good, healthy 16 years 17, if you go back to 2007, since we've had a good doozy of a recession, right? So would it be reasonable to think that maybe we're due, right? So again, rather than talk, take a look at what's in front of you. I'd always warn everyone I work with, and I don't care what we're talking about, be careful of the old, this time it's different crowd. How many were around in 2000, 2001, so forth and so on, when everybody was telling us this time it's different, right? These valuations are justified. Anybody around back then? I think I heard that phrase a million times. Oh, this time it's different though. This is not a bubble. It's never a bubble, ever. Every time things go straight up in the air, supposedly it's never a bubble. And then magically history proves otherwise. Every single time, actually, it was a bubble, right? How many were around in 2007 and 8, right? When the investment banks and Bernanke and everybody is telling us that housing prices are justified. There won't be a recession. I remember doing a webinar all through 2009 using a quote from Bernanke when he was testifying in front of Congress, where he claimed he did not see the US economy going into recession. History showed we were already in recession when he said it. Okay? So I'd be very, very careful with the this time it is different. How many remember all the talk about the yield curve a couple years ago? The inversion of the tens and the threes. You may remember that? And how we have seemingly forgot all about it? Because supposedly the yield curve inverted. We didn't get a recession right away. It failed, right? It failed. Well, what you're going to notice when we look at the last several yield curve inversions, that the recession didn't actually happen ever during the inversion. It came after the quote uninversion, right? If you look at what we just encountered over the past couple weeks, we have uninverted. After the longest inversion in history, if I remember correctly, right? What does that mean? What do these two charts combined mean? Okay. And the other 8, 10, a dozen that I have that show the same type of setup, if you will. Could they all fail? Sure. Could this time be different? You bet. But what do you think? When you look ahead to 2025, what's in front of us? And you see, in this example, 4-0. You look at the last one, 10-0. Got several others. They're going to show undefeated track records of forecasting imminent recessions. And again, let's not forget, if we take out the COVID induced, it's been a long time. So what do you think? And that's a real question. What do you think? Just sticking with these two charts. What do you think? You think we get through 2025? No recession? And I'm not asking what you think outside of this. If you look at these two charts and that's the only thing you looked at, what would you think? Would you think there's one, sure, it looks like we better be careful this year? Or would you say to yourself, meh, nothing? What do you think? And remember, I'm no more of an economist than any of you. What does everyone think? And don't be shy. You think odds are at least elevated, maybe? Right? And here's my thing. Right? Yeah, Sam, I don't think that's realistic, though. That sounds like a personal opinion. I think if we look, the question was looking at what's in front of us. And I don't know that any reasonable person, right, would look at these and say, nothing. I would say we probably look at this and say, well, maybe. Maybe. But obviously, as we know, time will tell, right? So when I look at, again, these are just two of, if we wanted to spend all day here, of 10 different historical measures, all kind of implying the same thing, right? What is the problem? Who says there is one? FYI, there never is one before there is one, right? It's kind of like market tops. Everybody's bullish at the top, right? There could be any number of problems. Yes, and but we're not looking at 10 years. That last chart, if you go back here, this is 70 years. And it didn't matter. It didn't matter if we're talking about financial crisis, if we're not talking about .com. It was never different. But again, hey, that's what makes the market, right? Everybody's free to decide what they want. But rather than rhetoric and bias and politics and cheerleading, I'm going to go with history. I'm going to go with what tends to happen in these environments. Or in this case, what has happened every time we've hit this environment. But let's move over to the market here. What happens typically, or at least historically, when the Fed starts cutting rates, right? Well, here's the last four. Last four easing cycles. What happened to the market? Once, if we go back 25 years ago, market was already in the bear. We didn't know it at the time, right? The second, third, and currently, right, there was a lag. Sam, so charts don't always predict the future. Oh, I started out that way, didn't I? I didn't say they always do. But I think if anybody looked at this, I don't think anybody's looking at this and said, yeah, absolutely complete garbage. I think most are saying, interesting. If you're not, I'd say you probably have some bias, which is fine. You're welcome to have it, right? But I'm looking at historically what happens in these environments. And everyone needs to remember too, everything's always fine before. Everything's always, right? Just like everything's at its worst when we bottom. Okay, remember back in 2009? Market bottomed way before the economy did. Right? Employment kept going higher, right? Even Warren Buffett got that one wrong. Okay. But yeah, quote, charts don't always predict the future. Exactly. If you want to go with the this time it's different, absolutely. Just keep in mind that's what they say every time. Every time it's different. Maybe it will be, right? Time will tell. But what's interesting about the easing cycles is that our mind would tell us, and obviously the news feed would tell us that that's a positive, right? History has not shown that to be the case, right? As a matter of fact, we don't even need to look at history. If raising interest rates were so bad for the market, what have we done all through 2022 and 2023 while rates were being raised? Moved higher, right? Market didn't care. More often than not, if you think about it, it kind of makes some sense too, right? If we're starting to cut rates, it's commonly not for a good reason, right? So this is more focusing on what the market does, right? As opposed to here, we're just kind of looking at, whether it be an economic indicator or whatnot, right? But here, what does the market do during these environments? So, and so when you go back to your comment about lowering rates, well, what has happened the last four times? And all four of those times, everybody said lowering rates would be good for the market, and not one time was it, right? So keep that in mind, everybody. Remember, you got to be careful with the bobbleheads and the agendas and people with their biases, especially in this political environment, right? My guy's awesome, your guy is terrible, right? Even though they do the exact same things. What do your eyes tell you? What does common sense tell you, right? And we'll see. Exactly, Dan. I think most people would at least be ready for a correction if they're being honest and unbiased and rational, right? Which is the only point I'm trying to make. Be careful out there, kiddos. Be careful out there, right? Now, top heavy markets. Again, focusing a little bit more on the market here. Top heavy markets don't tend to be good, right? So I thought this was a great one to show because we are talking about markets and such. And again, I'm not an economist, you know, chart guy and this, that, or the other. What we're seeing here is two different things. Obviously, the blue, when we take the largest stock relative to the 75th percentile, right? And then, of course, the weight of the top 10 stocks. And again, think of what has happened when we get top heavy like that. I use the example of like a shuttle going up and the boosters coming off, right? And pretty soon you have fewer and fewer, like as we go higher and higher and higher. Okay, it doesn't mean that there's only 10 stocks going up. That's what the bull clowns like to say. Oh, everybody out there saying only 10 stocks are going up. No one's ever said that. No one's saying that. What they're saying is these 10 stocks or these 7 stocks or this one stock is doing most of the heavy lifting. There's a big difference, right? But then you reframe it so you can make the bullish case, just like the bears do when they reframe it to make the bearish case, right? What I know is when markets get this top heavy, this that you see in front of you tends to be a warning sign, right? I think last year Nvidia accounted for 22% of the S&P's rise, a full nearly one quarter, one stock. And I believe, what was it, 5 or 6 stocks accounted for 2/3 of it. Was it Nvidia, Meta, Apple, might have been Google, Amazon, the main guys, right? So, but yeah, so, what do you think? History has shown when we get these top heavy markets, be careful, folks, right? Markets could be running into trouble. So you put these things together and, you know, we talk about what's the outlook for 2025. I'm not a huge fan of doom and gloom, and I'm not a huge fan of just bull cheerleading for the sake of bull cheerleading. So when I look at these, I say, hey, look, if history is a guide, then I would say just be cautious, right? Quote, don't get caught with your pants down, so to speak, right? So for us, when we talk about trading it, the good news, at least as it pertains, right? We're not investing, we're trying to trade. The good news for us is that whether up, whether down, right? We can trade it either way. It really doesn't make much of a difference when we trade options. And a lot of times we're on both sides of it, especially if we can get the volatile markets that we look for. So we would actually invite a correction. I would say, I'll take anybody's bet that there'll be a correction this year, right? And by that I mean 10% or more, not because we haven't had one. First off, we haven't had a real north of 10%er in the S&P since this whole bull market started, right? So we're getting a little close to 2.5 years in. You look at these things, right? Yeah, the roaring 20s. And again, I would also repeat, and hey, maybe we get more top heavy, right? Maybe this time is different, right? That's why, hey, maybe we make it this entire year and it's a party, right? But I think, we would want to be prepared for a correction, and that would be healthy too, by the way. That'd be very good for the market. Um, and so let's talk about that. Let's move to the market and let's talk about how we trade it. As I mentioned before, for us, it doesn't really make a difference. And as a matter of fact, we would actually prefer volatility. Volatility for us is a good thing, right? So real quick, just want to make sure everybody can see what we got here. And the pal keep his mouth shut. We'll see. I'm a huge proponent of that. The markets are way bigger, way more vast than any one person or one agency, right? Markets are going to do what markets are going to do, and markets are forward looking. So that's why it can be somewhat naive to think we can look at fundamental conditions right now, right? And then somehow apply that to what the market's going to do. Market is going to discount ahead of time, right? Or at least it typically does. So I'm a huge fan of market's going to do what market's going to do. We've been fortunate enough to forecast most major corrections, and we've never been wrong about forecasting one. And we'll talk about that here in a second. Because all these charts are fine, I wouldn't change my trading because of any of them, right? Not one of those is a timing tool, is it? Right? None of them is a timing tool. None of them says, hey, even if we are going to recession, it's happening tomorrow on this date. If we do have a correction, whether it corresponds with a recession or not, there's no timestamp on that, right? So that's what we kind of come over to what we see with, this is where chart work can really come in handy and allows us to kind of accomplish what we accomplish. All right. Now, first and foremost, all of our trading decisions are based on simply what the market's doing. Okay. I don't know why anything else would take part, right? I'm trading the market. I'm not trading the economy. I'm not trading the political environment. I'm not trading the news. We're trading the market, right? So we want to get this right. By the way, everybody see this chart in front of them? Just want to make sure. Hopefully. correction coming in April, May. I would say, I don't get too crazy with seasonality, but if seasonality has anything to say with it. Typically, that February March area can be a weak spot, and then we all know how that summer into fall can tend to go. So it's a great question, Enrique. Am I leaning bearish this year? I don't know that I'd say I'm leaning bearish this year. I think that we should be prepared for a nice, healthy correction, if nothing else. Right. Now, I'm going to show you what I look for before. I've never made a correction or bear market call unless I see one thing in particular. And every time I've seen that, the market has corrected or went into a bear market. I don't see anything like that now. That doesn't mean we need to see it to do it, but I'm not going to just, look at those four charts there and say, hey, we're going to correct, right? Right. But, we'll talk about what we do look at. Now, as in options gamble, we are shorter term trading, right? So, we're looking at trying to capture that next whatever, call it 2, 3, 5 day type of move, right? Um, so being on the right side of the market is going to be important. However, if we pan out a little bit, certainly we'd like to be on the right side of the trend, right? Because if we're in a bull move, your bearish signals are going to fail more often. If we're in a bearish move, our bullish signals are going to fail more often. So certainly helps to be on the right side of things, as the trend goes. Okay. So yeah, I don't know. I wouldn't say that I'm leaning bearish this year, Enrique, but I would say I would take anybody's bet if they want to bet we're going to make it through this year without a correction. And again, I'm talking about big boy corrections, not the talking heads nonsense where just because we fall a 0.5%, they want to call it a correction, right? Because they're bull cheerleading. I'm talking about a real one, right? That big nasty one where it's like, oh my gosh, right? Sky's falling, that 10 to 20% or more. Okay. And as of right now, again, I'll show you what I mean. I don't see anything that would lead me to believe that right now. But yeah, so let's talk a little bit about first and foremost, when we're looking at trades, everything that's happened in the last week was a pretty easy call, right? We put ourselves, the S&P that is, has put itself in a nice little, pretty standard bull flag. Resistance side tested 3 or 4 different times. Nice reversal last Monday. That's why we've been leaning on the call side. We obviously profited last week with our ISRG calls, and we've already profited with our Amazon calls. Our expectation is based on one, the overall trend, short term, nice simple bull flag. Odds seem to favor a break to the upside. Ta-da, this week we're breaking to the upside. And those of you that might already be in Gambit or Prime Time or whatnot, assuming we did break to the upside, what do we expect? New highs, right? So pretty straightforward stuff. So every trade we ever put on, okay, and options Gambit is going to be based on, of course, trying to get the market right. Keep in mind, anywhere 50% to 75% or more, but usually a minimum of 50% of a stock's move is going to be dictated by what the overall market is doing. Okay. Now, the reason why it's such, kind of can be such a wide range is obviously because, well, we talking about a little 0.25% up day or a 2% up day, right? So that obviously make a difference. Insurance hedge, yeah. Well, I would say sometimes hedges. I would say our hedges are supposed to lose. If they don't, that's just a Christmas gift, right? But we take that into account when we put our trades on. Just like these, we had a hedge on when we put our Amazon trade on, but we'll get to that in a second. All right, so sometimes it doesn't have to be that hard, right? I've coached again thousands of students. They got 85 million things up here. No, I'm not really using the bands or the 30-day anything like that. I do teach a lot, so you'll see this change from time to time. Up until a month ago, I think I had 3 different moving averages up because I was teaching one of my classes on just understanding the different moving averages. That doesn't mean there aren't some things that are worth knowing here and there, but at the end of the day, right, we're focusing on just keeping it simple, stupid, right? Basic price patterns, basic levels, no different when the S&P finally took out, right, that old, again, those of you that have been around, the old 56.75, our expectation was to keep running higher, okay? Markets have been pretty good with a lot of this. Here's the Nasdaq 100, very similar with its bull flag there. And the Nasdaq 100 has been pretty helpful a lot of times, right? If we go back, take a look, okay? And notice how simple it can be, right? Nice little channel, break out of the bottom of it, probably going lower, right? Narrow it down further, right? You fall into a bear pennant, probably breaking lower, ta-da, you did. On and on and on, right? Once we came out of it, breaking our resistance line, all right, I don't know that we're doing this, but it certainly seems as if this stage of the downtrend is over. Rally up into a little bull flag there. Look at that cute little guy. Implies an upside move. That's what we get, right? So it doesn't have to be near as hard as everybody makes it. But keeping it simple doesn't sell, right? VWAP with your Elliott wave combined with your Fibonacci, combined with your 3 moving averages, combined with your 3 momentum indicators, whoo, and all your Greeks. That's the recipe for success. Or playing devil's advocate here, another bull flag. How many were on our calls when we said, hey, we should be breaking to the upside, and assuming we do so, should be running to new all-time highs? Not that terribly complicated, right? So we're seeing the same thing here. So first and foremost, everything that we look at when we put on an options gambit trade, okay, we're going to look at what do we think the market's doing, and we're going to focus on more of a now time frame, but always want to be aware what the overall trend is. So notice how whether we have a recession this year or not, or whether we have a correction or not, or a bear market, our time scales are not really going to be affected by that. Okay. Again, certainly helps to know we're in a downtrend or uptrend. Okay. But we can capture down moves just as easy as we can the up moves, assuming we're doing our homework up top here on the board. Right. So I always start there. So coming into this week, right, setting up for, let's talk about the 2 trades we put on, Amazon and Shopify. Shopify was just the hedge. Why did we do what we did? Well, first off, we saw this reversal coming off of it. Obviously, this was to Friday of last week. Okay. Our belief was, as we stated, hey, probably break into the upside. If we do, should be going higher. Broke to the upside, got on our call yesterday. Here's Tuesday. Yesterday morning, right out of the gate, we bought the Amazon 235 calls. Anybody in options gambit want before I say anything? Because you get those every once in a while you get those people on webinars that are, cynics about everything. Anybody in option gambit want to go ahead and tell me how much we paid for those 235 calls? And I don't mean if you paid an extra penny or saved a nickel or anything like that. What was the debit amount? Feel free to type it in so everybody can see. Or I can just say it. Give everybody about 10 more seconds. I think we have some options gambit people on here. I thought we did. No biggie. We paid 80 cents, right? And not too hard to see, right? We just go back and look. Option gambits call, we come in from 9 to 10 every Tuesday. So right when the market opened, right, we can go back over here. Go to yesterday's open. Here we are. Voila. Okay. Shot up a little bit, pulled back a little bit. We got in at 80 cents. Okay. Our thought was, again, market go higher, right? So we thought market would go higher. We chose Amazon. Why? Check out Amazon's nice little bull consolidation. It had popped out of the top of it. And our thought was target 1, 235, target 2, 240. And whether or not we stay in for 240 or not really depends. Well, how quickly do we get to 235 if we assuming that we get there? All right. So put that trade on for 80 cents. And the minute we sent out that alert, or in that alert, we set the sell limit yesterday. Sell limit was $2.40, $2.40, which was hit about 30 minutes before we got on this call. Okay. Pretty straightforward, easy, 200%. And I want everybody to notice there's not a lotto or anything, right? It's just having a nice, good, sound grasp of one, what the market's doing, picking the right stock and understanding what it's doing, and then the option price that makes the most sense. Okay. Are there multiple choices with that whole which one makes the most sense? Sure. Right. Could have bought the 240s, could have went at the money, could have done any number of things. We tend to go a little bit further up there, try to get those higher percentage gains. Now, at the same time, right, because we could very well have been getting faked out, right? Shopify, that was our hedge, okay? The stock, even with the market kind of pushing higher, this thing had broken down, ran back up last week, running right into the old breakdown level of 105. So at the same time we bought those calls on Amazon, all we did was put a half position in Shopify, just a small hedge. Not only does the stock look like it wants to run back over, but if the stock pulls down, this one's like a perfect candidate to look for a run back to 100. But this one's never intended to succeed. Okay, simply there to protect us, right? And it was half the position size of Amazon, right? Hey, if market wants to roll over or the stock wants to, independent of the market, okay, we got this to cover us. And the minute Amazon hit today, we closed out what was left of this. All right. So Gambit doesn't really try to overcomplicate things. Okay. Nor does anything I do, right? Because there's no point in it. Okay. If you get risk reward right at the end of the day, everything else is a moot point. Think of risk and reward as almost like the left and right bar if you're playing euchre. Okay. If you are risking a little to make a lot, you're probably winning in the market. If you're risking a lot to make a little, you're probably losing. End of story. Right. So we focus on that. No different than discipline and emotion. I guarantee you, somebody in Options Gambit yesterday, probably multiple, probably dozens, closed this thing out before today. When it shot up a little bit, we were up about 50% at one point yesterday when it hit its high. Somebody somewhere probably closed this out of fear, right? That we would push lower or reverse, right? Which we very well could have. Okay. But that's the hardest thing that I have is getting members to follow what we do, right? It's easy to say we have a good risk reward, but are you going to stick to it, right? Are you going to let the reward do what it does? If we decide to exit, are you going to get out? Okay, that's the hard part. Okay, when we analyze the market, now the market isn't always showing us something, so sometimes like, well, I'm not really sure, so we might be on it regardless. Last week we were on both sides of ISRG. Now we started this as a call play. Okay, stock had a great day. We thought this thing should go to 600. All right. Didn't quite make it there. What do we get to? 597. All right. It seemed at the time we put on, now keep in mind, I can't put trades on at 359 every day. So I got to put them on at some point, right? Looked like we were going to push up through this channel, which would imply an acceleration of the move. Okay. Didn't quite get that. Next day, this being Thursday, we dipped. So what did we do? We had the 595 calls. We used the dip as an opportunity to roll those calls all the way down to the 590s. In other words, increase our odds of winning in the scenario where we rally. But we also threw a hedge right under the low of the day. Low of the day, 573. We bought the 570 puts, meaning that if we were rolling down and we take out that low of the day, could be coming all the way back down here. Okay, very simple. So sometimes we'll, too close for missiles, we're switching for guns, right? Switching to guns or evasive maneuvers, all right, when something doesn't go. So we might work a trade. This one we happen to work in, I think this ended up being a 170% gain, and it recouped the cost of the rolls, right? The roll and the hedge, right? So this started as a call play, and then once the stock threw us a little bit of a curveball, we use that to our advantage, right? Waiting for the stock to drop is a great time to bring the calls down because they're less expensive. All right. The hedge, maybe we didn't need to do it, maybe we did, but keep in mind, this channel has been awfully good at sending the stock backwards when it gets there. Right. But ultimately, we end up being right and it broke above. Unfortunately, didn't get all the way to 600, but it went up enough for us to profit. Okay. So sometimes we will do things like that. Sometimes we will obviously work a trade. Sometimes we'll go right into a trade with a strangle, just buying puts, buying calls. And the reason why that's important, okay, specifically the strangle part, is by far our most profitable periods of time have been when we have corrections, when we have bear markets. Why? Because volatility is higher. Okay, the most profitable period of time we ever had, or at least pretty darn close, would have been COVID crash, right? So if we go back, right, this little gem back here, okay, when we're getting 5 and 7%, 11% once, hitting circuit breakers right and left. Okay, but look at the volatility though. Okay, yeah, overall it's down, but look at these rallies. Okay, look at these big guys. This thing looked terrible, but what do we do the next day? Completely reversed it. Same thing here, right? So this was a great time to take advantage of that volatility. Okay. So it's like, well, we could pick puts, we could pick calls, but heck, this thing's flying around so much. Let's just be on both sides of it. And that was by far and away the easiest and most profitable period of time we ever had, right? Because it didn't really matter, right? We could almost buy anything, right? And if we were on both sides of it, we didn't even have to get the market right because of how it was chopping back and forth, back and forth. Now that's a different environment than say this one, right? This one here, not quite the same, but this was the bear, right? But it doesn't change the point. So when you look at the year ahead, okay, would a recession concern us? No. Would a correction and or something worse concern us? No. As a matter of fact, that would make it easier for us to profit. Okay, a lot easier. Okay. When we have these dead calm type of things, we're not really putting on spreads, right? We're not trying to just capture a couple pennies here and there. Okay. We're looking for small trades are 1 and 200%. That's a small winner. Okay. If we can get something bigger, that's, if we wanted to, we could have stayed in Amazon and see if it wants to run to 240. Could have, right? But we said, well, had that sell limit. We'll see how it goes. And it triggered today. Now, I do want to circle back to, okay, well, what would make me think that a recession or correction is coming? Well, like I said, the only time I've ever called anything like that, is going to be a handful of times. Now, I'll just focus on the monthlies, but there are some weekly examples also. And this is where, something for me like the RSI really comes into play. When we talk about a momentum divergence, all right. Now, remember, when you start talking about technical analysis, the larger the scale, the more reliable the quote signal, the larger the implication. So I don't get too much on divergences on 1 minute, 5 minute candles. I don't know how effective that's going to be specifically for what we are looking to do. But if we're going to make major calls, we want major time scales. So for those of you that are not familiar with what that divergence might be, you can see down here, RSI, your relative strength index, simply keeping it simple, measuring momentum, strength, momentum. Okay, the security within itself, different than regular strength where you're comparing to securities, right? So if you look here, this was back in 2007. This was back when I first started coaching. It's the first time I ever even got the opportunity to call a correction or bear market. You're going to notice how S&P goes up, hits a high, sells off here. These are monthly candles, rallies back up to new highs. But notice what's happening down here at the RSI. Okay, as price hits a new high, momentum hits a lower high. Okay, somewhat implying that we're losing gas. Like, hey, this time up wasn't as strong as the one before. Flip it upside down and you would have a positive divergence. Kind of what we saw at the 2022 low on the Nasdaq 100. We saw a weekly positive momentum divergence. Okay, these tend to be very reliable. Why? Because think about how much data it takes to make that happen. Very difficult to put one of these in. Again, not like a 5 minute candle or intraday or even a daily, right? They don't fire off too often because as you see here, we've only had 5 of them in the last 25 years. Okay. So what you're going to notice, 5 and 0, right? When we get one of these big guys here, what this tells us is 50%, 50%. I think this was 18%. This was 20%. So when we went into 2022, that's when we started calling for, hey, probably correction time. Maybe even bear market time, because look at this straight up in the air type of move. These moves never end well, right? And so when you pull that rubber band, it's going to tend to snap back a little harder. So our guess was, or our forecast, if you will, was anywhere between 20 and 50%. Look back at the previous 4, we fell 20%, 20%, 50%, 50%. So somewhere between there. What did we get? Whatever it was, 30 some odd percent. Okay. And as you can see, as of right now, we don't see anything like that. Some point this out from major peak to major peak to, is it a kind of a longer term type of divergence? Maybe. Certainly, I can't argue with somebody making that case, right? That if you look at where momentum is here with this peak versus back here, right? And now look where it is. Sure, I can't argue with analysts that are making that case. But it's not really what I focus on as much as trying to get that, again, what's right in front of us as often as possible. You're going to notice, even though we're kind of pushing to basically new highs here today, we're testing them anyway. You notice as of right now, momentum's a little lower than the previous peak. So we could be very similar to what happened back here. So we'll keep an eye on it, right? Now, as I said earlier, that doesn't mean there's been one of these every time we've had a correction. Okay. It's just when there has been, right? And that's the only time I'll step out and say, hey, better be careful, folks, right? Watch out, kiddos. Probably something bad coming. All right. No guarantees, but so far for the last 25 years, 5-0. So this was the 2022 peak. Now we saw the momentum divergence. What did we want to see? Price confirm. Well, we had this wonderful little channel that we had. Look at the respect of this channel here. Remember, the market's drawing this, not me. I didn't make it stop at that green line 10 times. It did that. Okay. Same thing here on the downside. So once we broke, that was our price confirmation. Rallied right back up to the underside of it, right? And up and away we go, or down we go. Okay. Now, if you look at the Nasdaq, as I mentioned, for those of you that are new to that, the flip side, we can flip that around and you can kind of see right back here. Nasdaq going on to hit these new lows, but look at how momentum was creating higher lows. Think of it as we're losing steam on the downside, if you will. So think, circling back to the year, what to expect for the year. As I said, showing those charts in the beginning, my advice for what it's worth is just be careful, right? Um, Everybody's going to cheerlead the bull, and they typically don't wave a flag or ring a bell at the top, right? Markets are going to do it with a whimper for no reason whatsoever. Okay. History says odds might be elevated, if nothing else. If you want to ignore it, and say, hey, this time is different, cool. There's a couple books I could recommend to you. A whole chapters on the naivety of this time it's different, right? Because they always say this time is different, and commonly it is not. Okay. So yeah, when we talk about this year, part one, be careful, be cautious, look for signs of breakdowns, right? Remember that we don't just go straight up in the air. Okay. The market wise, obviously, any number of ways we can get those little tips and signals, whether it be some of the patterns we looked at or the momentum divergence. How options gambit changes it or trades it, it doesn't really matter. We don't really care either way. We do stick to, as I highlighted, just calls and puts, right? Sometimes we will play with those in the form of a strangle or hedges and things of that nature when we deem it appropriate. And, how's that worked for us? Well, let's see. I'll come back to this. Everybody see that old chart there? It was the last one we left with. Everybody see the market cap one? Just want to make sure. Okay, cool. Options gamut, we do pretty well, right? Had a great past couple months. That's our last 6 months, right? And then since inception, yeah. And it's not too terribly hard. We'll always have a track record like this. Why? Because we subscribe to those basic ideas. Risk a little to make a lot. Risk a little to make a lot. Risk a little to make a lot. That's how you get the edge. To be honest with you, that's how you put odds in your favor, right? Just do the math on it, right? If you're risking one to make two, like we basically did here with Amazon, versus if you're risking two to make one, you're just making it easy on yourself, right? So that's kind of what we expect. That's kind of how we would trade it. And if any of that sounds like a good time to anybody or want to hop on board, I know that T3 is offering a half off for the first year of Options Gambit. So I'm going to pop that link in there. If you'd like to hop on the phone and talk to Josh instead, many of you have probably seen him on the call, but right there's a link. And I am going to hang out a little bit. So if you have some questions, be more than happy to kind of cover them for you. Oh, nice, Paul. You got it for 90 cents, sold it for 270. Okay. So you did about, same as we did. Good job. What exactly is the point theme of this presentation? I think it's kind of pretty straightforward, right? In the title, 2025, how to trade the big moves of the options. So, and I think in the copy, kind of talked about, 2025. What we think would be coming, then how we might trade it. Now, the bottom line point of how we would trade it is it wouldn't make a difference to us, right? And as a matter of fact, we would invite, you know, um, volatility. That'd be good for us. And I can tell, I recognize a bunch of names on here. All of you know, like when we get more volatile versus less volatile, lower volatility actually hurts us a little bit because we kind of, we depend on things that are moving, right? And that's why we stick to the stocks we do. This morning in, like, say, prime time, for example, Nvidia jumping $5 or whatever it was right out of the gate. That volatility is good for us because we tend to be out of the money with a lot of our trades. We want to give ourselves, again, 3-4 days for our trade. That's why we come on Tuesday mornings, right? And look to put trades on, give us a nice, good 3-4 day period of time. And we want volatility. So we don't tend to trade, some of the more conservative names. So, but as you can see, right, we do very well. We always have. Doesn't mean we don't run through any kind of road bumps like anybody else. But when it's all said and done, remember, it's kind of hard to beat if you're on the right side of the market, if you're in the right stock, picking good risk reward setups in the form of the options, and then being able to be disciplined enough to let those things unfold, right? So if it's, you're looking to make some money this year, that's what we're going to do. It's what we've done every year since we started. Love to have you on board. How it works, obviously, trade alert service, trades go out, but we also do our call every Tuesday morning when we come on, and I can answer questions, talk about why we did what we did, and then, of course, we look to put on a live trade if we can. That call is 9 in the morning Eastern, and then, again, we're there for the opening bell. And then it's pretty straightforward, simple stuff, right? We have the VTF, so alerts are instant when you have the app. And then I'm there for support for anybody that needs it. So yeah, if you'd rather get on and talk to somebody about it, Josh is here. You can see his phone number right there in the chat box for you. And he'd be more than happy to talk to you and just answer any questions and that. But they are offering a pretty good deal on it. Half off, I believe, is what they decided to do for new members only. Don't try to pull any tricks, all you Gambit people. But that's for new people to come on board and give it a whirl, right? The service puts, now remember, this is just the service and me for track record purposes. You want to put into a trade whatever you deem appropriate, okay? But the service puts $1,000 into each trade. Used to be 2, then we had 5. Then we said, okay, let's just leave it at 1,000 where it's at, okay? Which is a good time trying to adjust all the trades. Okay, so in other words, with Amazon today, that was a 2,000. I'm sorry, it was by the time you take out the hedge and all that, I think we made $1,600. All right, but if you had one contract, you still made $160 or whatever it was in the trade. Right. So those are the kind of gains we look for in the service. Nick, I think I answered that maybe right after you asked it, but 9 o'clock Tuesday morning, they are recorded. So if you need to play them, track record, all trades are kept. So there's full transparency, no tomfoolery or anything like that. No, Mixman, we do not sell options. It's strictly long. Yeah. So with Amazon, we just bought calls. Shopify, we just bought puts. That was it. And we didn't need the puts. Like I said, the belief, if everything went as we projected, is that we would lose on the puts. But like I said, they were like half the cost of the calls. And so, you're welcome. What else? Any other questions? Again, we covered the time, trades. I don't know. We average 1 or 2 trades a week, so it's not crazy time. We're not trying to day trade or anything where you need to be tethered to your computer or anything like that. Right? You can go about your business. You don't need to attend the call, but it helps a little bit, right? Because you're right there, and with ample amount of time before I put a trade on, because we're talking about it, right? We're talking about it before the market opens. Everything you heard me cover on that with the market, we talk about that on the call. Okay. So next week, options gambit people already know about that flag. They already know we expected to break out. They already know, right? So they're putting on trades above and beyond gambit based on the analysis we discussed on Tuesday. All right. There is a second call that all Gambit members get access to, and that is the Monday market cast call. So technically, we cover the market twice. So if you replay Monday's call, right, everything that's happening right now is exactly as forecast. Why? Because the market implied that's what it was going to do. And all we're doing is reading the market, right? We're not running rogue over here. And if you have any other questions I can't think of with the service, again, you can hop on the phone with Josh as you see, we make money all the time. So if you're looking to make money all the time, option gambit's for you. And by the way, I'm more than happy to hop on the phone with you as well. Otherwise, circling back to the beginning, yeah, just be cautious out there, everyone. Be cautious. I would say, again, wouldn't bank on seasonality and everything, but we know we've gotten some doozies over the past few years in that summer fall period of time. Wouldn't be surprised. February into March sometimes isn't friendly. Randy, so smart trades is like that's just trade. That's options on ETFs, and those are trades that go out weeks, if not months. So if you look at that GLD trade that Smart Trades is currently in, we went out 2 months in that trade. Options Gambit, we're trading first off stocks, and we're trading every week, right? And these are all same week expiration. That's where again GLD we went out, right? 2 months out to March. So far so good on that front as well. Here I can show everybody that trade too. It's not an option gambit trade, but it's to show everybody what we did here. Because one thing I tell all of you, if you're kind of newer or struggling, right, it can be very, very tempting, right? Because there is a lot of quote, I don't know, I think gimmicks and scams, but it is a part of the industry where you're led to believe things have to and need to be way more complicated than they actually do, right? You are led to believe that if you're not using some Bollinger Bands or if you're not looking at VWAP or volume profiles, there's no way you can win. That is a joke. Laugh in anybody's face, okay? And ask them, how in the world did traders live before trading platforms? How did they do it, man? Right? It's because that's silly. You can use whatever indicators you want. They're all going to work. They're all going to fail. And that's dependent on the stuff we've talked about. Same thing with options and getting notice how, by the way, I never said anything about any Greeks. I don't care about any Greeks. Who cares? Amazon runs a 235 in a day or two. We're profiting. And we had the sell limit full day and a half before it ever happened. You don't need the Greeks. I'm not saying there's anything wrong with it or anything. I mean, I can talk your head off about delta and gamma and all that stuff if you want. So I taught it for 6 months, right? But that's not the same as you need it. So you kind of get duped, right, into thinking and overcomplicating, and that overcomplication actually leads to a lot of your failure. So how about this? Very simple standard consolidation pattern. Hey, implies an upside break based on the preceding trend. If we break through, maybe I'll buy some calls. Ta-da! We bought calls in GLD. We're looking pretty good. Not that hard, folks, right? So if you run into those people kind of leading you to believe otherwise, I would just say turn around and run the other way. Either one, they're trying to sell you something, or two, they don't know what they're talking about. Remember, any gamer in their basement can have a YouTube channel or an X account and Photoshop some trades. Okay. Unfortunately, for people like me, our trades have to be transparent, right? We can't sit there and claim that we made these. Anybody on Twitter or X? Anybody notice how those guys magically somehow they never have losses? Isn't that weird? Isn't it crazy how anytime on a whim they can take $1,000 account and turn it into a $10,000 account just like that? Did you guys know trading was that easy? I didn't. I did not know that until I got on X. Right? It's weird. So best path will always be keeping it simple, right? And that's all we do. But smart trades, as you can see here, that's all we did. And that's what we will typically do. But again, smart trades, we don't put on a lot of trades. That's ETFs, right? And I think we made a few pennies last week on SMH. That was the shortest term trade we put on in a long time. And the cool thing about that is we made money on the reversal. We were on both sides of this. We had the calls, then this little guy came in. I'm like, uh-oh. And we added puts, and we worked out to our benefit, right? So we were able to not only pay for the trade and the hedge that we put on, and I think we rolled it once or twice. We also walked away pretty profitable too. So yeah, options gambit is pretty cool. Like I said, we profit every year, always have. If you understand how trading works, you can see why that's the case, right? Risk a little to make a lot, probably doing pretty well. Risk a lot to make a little. Same thing when we talk about and trading is definitely not right, JB. You sure it's not that easy? Because they act like it is. Yeah, just slap up a VWAP. Ta-da! You're a super trader. Weird, weird. I did not know that. Huh. Here I was thinking it was hard. But yeah, so that's why you want to make the decision making process as simple as you can. The hard parts are like that emotion, that psychology, right? FOMO, fear, all those kind of things. But yeah, GLD is working pretty well. Um, but yeah, this was one of the first and only trades that we kept it kind of short term. But again, think about you. Just think about it yourself, right? Nobody ever blew up a trade. How many of you blown up a trading account? Anybody blow up one of their trading accounts? Right? You threw 5 grand in there and lost it all, or 2 grand and lost it all. Anybody blow up a trading account? I mean, I did. I blew up a couple. Right? At no time are the Bollinger Bands the reason you blew up your trading account. At no time was it the 8-day moving average's fault. We blow up trading accounts because of one, putting all of our money into one trade, or two, revenge slash over trading. That's how you blow up trading accounts. But see, can't fix that in here, can you? There's no indicator over here that fixed that stuff, right? So can't sell that. That's the problem, right? So position size is key. Good risk reward setups. Make sure. Why did you pick that option you did? Right? Is it a good risk reward? In other words, does it favor you or does it favor the market? Okay. And then have the discipline, right, to stick to your plan. So, but all right, I'm gonna let everybody run. Hope to see some of you on next Tuesday's call. We're already done for our week since we knocked Amazon out of the park there. So Gambit is dormant for the rest of the week, but we'll be back on board 9 o'clock in the morning Tuesday, looking for more trades, looking for more money, right? Hitting new portfolio highs as you saw over and over and over again. So we're gonna try to keep that gravy train going. Hope to see some of you there. No matter what, everybody have a great year and make some money, right? See you on the other side.